Two men, same salary, same city, the same $50,000 in savings. One buys a rental property, the other invests in index funds. And right now, your brain has probably already picked a winner. Maybe you think the landlord wins because real estate feels tangible. A key, a tenant, a house you can drive past. Or maybe you think the index fund investor wins because compounding quietly outperforms almost everything over time. But here is the uncomfortable part. 20 years from now, their results may be surprisingly close. The real difference is not just how much money they make. It is what they have to pay to get there. One pays with debt, maintenance, tenants, and problems that can show up at any hour. The other pays with long periods of boredom, painful market crashes, and the discipline not to panic. So before you choose a side, ask yourself one question. Did you really account for everything? We are counting the hidden costs that are easy to miss at the beginning. Cash, debt, maintenance, repairs, taxes, time, stress, risk, and behavior. Welcome back to Money with Tommy, where we stop guessing about money and start running the numbers. Meet Ethan and Noah. Same age, same city, same $55,000 salary, the same $50,000 in the bank. No inheritance, just one serious financial decision and two very different outcomes. Ethan uses his $50,000 as the down payment on a $250,000 rental property. It is a modest 3-bedroom house. He takes out a 30-year mortgage at 7% interest, with a monthly payment of about $1,330. Then he finds a tenant willing to pay $1,800 a month. That leaves $470 every month. Noah takes the same $50,000 and invests it in a broad stock market index fund. No leverage, no tenant, no house, no keys. He sets up an automatic monthly contribution of $300 and goes back to living his life. If you had to stop right now and make a prediction, who would have more money after 20 years? Ethan, the landlord, or Noah, the index fund investor? Keep that answer in your head. Most people get this wrong for one simple reason. They count what they can see. They ignore what is hidden. For the first few years, Ethan looks like he is winning. The rent hits his account. The tenant helps pay down the mortgage. The house slowly increases in value. And every month, Ethan owns a little more of the property. It feels active. It feels smart. It feels like progress. So let us open up Ethan's $470 monthly profit and see what is really inside it. By the end of year 3, Ethan has collected roughly $64,800 in rent. That sounds incredible, until you start subtracting. Mortgage payments consume about $47,880. Then come property taxes, insurance, maintenance, repairs, vacancy, cleaning, and relisting costs. After all the real costs, Ethan's actual net cash flow over 3 years may not be the $16,920 that appeared on paper. He may be left with only $2,000 to $4,000 in total, and that does not include a single hour of his time. If Ethan manages the property himself, he saves the management fee. But he pays with his evenings, his weekends, his attention and phone calls that can come at any time. If Ethan hires a property manager to deal with these problems, the cost becomes visible. If he manages the property himself, the cost becomes invisible. But invisible does not mean free. It simply means the spreadsheet is not telling the whole story. Now, to be fair, Ethan has one very powerful advantage that Noah does not have: leverage. Ethan invested $50,000, but he controls an asset worth $250,000. If the house increases in value by just 3% in 1 year, the property gains $7,500. That is a 15% return on Ethan's original cash before costs. That is what makes real estate so powerful. The bank's money is working alongside his own. But leverage is not magic. It is simply a multiplier. When the numbers work, it magnifies the gains. When the numbers stop working, it magnifies the pressure. Noah's situation is the exact opposite. His $50,000 controls $50,000 worth of investments, but his money is spread across thousands of companies instead of being tied to one house, one neighborhood, and one person paying rent. Ethan's risk is operational. Noah's risk is emotional. Ethan has to survive repairs, debt, and bad tenants. Noah has to survive volatility, boredom, and panic. And that temptation to panic is very real. At some point, March 2020 arrives. Noah opens the app and watches his balance fall every time he refreshes the screen. His hands begin to shake. For a few minutes, he wants to sell everything just to make the pain stop. Then he tells himself one thing. The only thing that has changed is the number on the screen. So he does not sell. 2 years later, he can barely remember that week. But if he had sold, the entire strategy would have fallen apart. That is the hidden cost of stock market investing. Not repairs, not tenants. Behavior. Maintenance alone can cost 1% to 2% of the property's value every year. On this property, that means roughly $2,500 to $5,000 annually. Some years, it is a $200 faucet. Other years, it is a $7,000 HVAC unit. Then there is the risk nobody wants to talk about at the barbecue. A bad tenant. A tenant who stops paying can create 3 to 6 months of lost rent, along with legal expenses. One bad tenant can erase an entire year's profit. There is no index fund equivalent of a tenant who refuses to pay rent or refuses to leave the property. His real cash-on-cash return has dropped to somewhere around 3% to 5%. Meanwhile, Noah is still doing almost nothing. He has simply continued adding $300 every month and left the investment alone. By year 7, depending on market returns, his portfolio may be worth roughly $135,000 to $150,000. Ethan's wealth grows through property appreciation, mortgage paydown, rental income, tax advantages, and effort. Noah's wealth grows through regular contributions, diversification, time, and discipline. By year 10, Ethan's property may be worth somewhere between $335,000 and $350,000. His remaining mortgage balance may be around $165,000 to $170,000. That gives him roughly $165,000 to $185,000 in equity before selling costs and taxes. Noah, with the same $50,000 starting investment and an additional $300 every month, may also have somewhere between $165,000 and $180,000 at the same point. They are almost even. This is where the online argument begins to fall apart. Real estate supporters expect Ethan to crush Noah. Stock market supporters expect Noah to win. But the difference may be much smaller than either side expects. The real difference is the path they took. Ethan may be slightly ahead, but he worked for that advantage. Noah may be roughly even, but he protected his time, his liquidity, his simplicity, and his peace of mind. So who made the smarter bet? Keep watching, because the point where the story truly separates is year 20. By year 20, Ethan's property may be worth roughly $450,000 to $500,000. But this is where many real estate comparisons get something wrong. Ethan has a 30-year mortgage. After 20 years, that loan is not paid off. On a $200,000 mortgage at 7% interest, he may still owe a little more than $110,000. So if the house is worth $450,000 to $500,000, his equity may be somewhere between $335,000 and $385,000 before selling costs and taxes. Over those 20 years, Ethan may also have kept some additional cash from the rental income. But that depends entirely on how many expenses the house generated, how long it remained vacant, and how reliable the tenants were. When everything is counted carefully, Ethan may end up somewhere around the $400,000 mark. Noah, meanwhile, kept investing. His original $50,000, plus the $300 he contributed every month for 20 years, adds up to total contributions of $122,000. With an average annual return of around 10%, his portfolio may be worth approximately $420,000 to $460,000. If Noah had increased his monthly contribution from $300 to $500, his portfolio could have grown to somewhere between $550,000 and $600,000. Just an extra $200 a month. No second mortgage, no second roof, no second tenant. He simply adds more fuel to the same machine. That is one of the quiet advantages of index investing. Scaling it is simple. Real estate can be scaled too, but usually not quietly. A second property usually means another down payment, another loan, another tenant, another roof, and another system to manage. But now let us be honest about the other side. The stock market is not a magical money printing machine either. In 2008, the market fell by roughly 37%. In March 2020, it fell by more than 30% in just a few weeks. Watching $150,000 fall to $95,000 is not just a number changing on a screen. It genuinely hurts. Index funds also do not provide enough monthly income to replace a salary. Dividend yields on broad market funds are often around 1.5% to 2%. On a $150,000 portfolio, that works out to roughly $200 a month. That is not enough to support anyone on its own. Real estate may also offer tax advantages, such as depreciation. House hacking and markets with strong rent-to-price ratios can dramatically change the numbers. Real estate can produce strong returns if it is purchased at the right price. The rental income covers the expenses, enough money is set aside for future repairs, and the property is managed like a real business. Index funds can also produce strong returns if the investor contributes regularly, avoids panic selling when the market falls, keeps fees low, and holds the investment long enough for compounding to matter. But if you fail to account for the true cost of a strategy, it will not work over the long term, no matter how attractive it looks at the beginning. The real mistake is choosing one based on a YouTube title, a podcast clip, or a single opinion you heard from someone else without calculating the numbers for your own situation. So before you make a decision, ask yourself one question. Did you really account for everything? Your starting capital, the debt, the taxes, the expenses, the repairs, the periods when the house remains vacant, the time you spend, the stress, the liquidity, and the risk. Because the right answer only becomes clear when you look at the entire picture. Who did you think would win before seeing the numbers? Write your honest answer in the comments. If you had only $50,000 today, would you buy a house or invest in an index fund? You can answer with just one word: house or fund. And if you want to keep improving your financial life and move toward building real wealth, hit the like button and subscribe to the channel. See you in the next video.